Hi again, everybody. Welcome back to Markets on the Move. I'm Marlin Bohling with you, along with Oliver Slope of Blue Line Futures. Oliver, let's take a look at the Wednesday market action here. Had a bit of a bounce back in the grain markets, although it seemed like they kind of ran out of gas, maybe in the last half hour of trade a little bit. And then a big turnaround from some big gains that we had in the livestock trade, namely in the cattle market, but that all pretty well disappeared by the close. Interesting stuff in the precious metals and the energy markets today. So I would imagine you probably want to start by taking a look at this grain market action here. Can you even read much into what happened here on Wednesday?
I'm reading a lot into it. Believe believe it or not. I mean, corn. The fact that it was higher today's trade after yesterday's report, I think speaks volumes. The way I look at things, I mean, you come out with a 188.8 yield for the national average and add 2 million acres to things, you would think that the market would have reason to accelerate lower. But to me, the price action, even following the report, yeah, we were 14 or 15 cents lower yesterday, but we were really just a few cents below last week's low. So the fact that we didn't see a reacceleration of selling pressure leaves me to believe that the market did a really, really good job of forecasting some pretty bearish numbers. So the big question is, when you're talking about markets and trading and risk management and the futures market in general, is you're looking at expectations and how the market is positioned for that. The expectations being set really, really high in yesterday's report and not really any follow-through selling. Where's the opportunity? I think the opportunity is potential kind of a regression of those higher yields, and potentially that helps us maybe carve out a little bit of a low, particularly in that corn market.
So are we hugging some critical support on the December corn market right now?
Yeah, we are at some big kind of an inflection point for the market, I would say. And I'll pull up this December corn chart if I can get my program working here. It is on our Blue Line Edge trading platform, which is a fantastic, very user-friendly platform for clients, desktop and mobile. It's a great platform, whether you're trading or just monitoring quotes. So here we've got the December 2025 corn contract pulled up. Obviously, the path of least resistance has been lower. You don't need to be a seasoned technician or trader to see that. But $4 is going to be that psychologically and I think technically significant line in the sand that we want to get out above. And then above there, you're looking at that resistance pocket that we talked about last week, that 408 to 411, which were the old lows from middle of July, and then the breakdown point from the first week of August. So if we can get out above $4, we need to get out above 408, 411. If we can see consecutive closes out above there, potentially things get a little bit more interesting. Talking about interesting, I think soybeans and the price action and the report yesterday is probably where things get a little bit more spicy and potentially more exciting going forward.
Yeah, in fact, I was looking at a November soybean chart earlier today, and it seems like it actually bounced and exceeded a retracement level on the chart now. And now I don't even know where the upside resistance would be.
That's exactly right. And last week at this time, I was saying, man, I don't know what the story would be for beans to really have a meaningful rally at this point. Maybe we can get back to the cluster of moving averages, which came in the mid 1020s. But yesterday's report, I think, changed the fundamental narrative, and it also really changed the technical narrative as well. Here we've got the November soybean chart pulled up. And as you can see, last week we were able to defend trendline support going back to December of 2024. We tested and held that in April, tested and held that again last week. That was 982. And then we got a breakout above trendline resistance near 1012, and then these moving averages. So fundamentally, the reduction in acres and production certainly changed things. And then you have the fundamental picture or the technical picture getting out above some of these technical levels, really kind of, I think, feeding on the momentum in today's trade. So the next upside targets that you're really looking at from here, we closed this small gap from July 7th that came in at I believe 1044, give or take. Next upside objective you're looking at is that high from July 3rd, which is 1058. And above that, you're looking at the top end of this year's range, which is 1075, 1080-ish, give or take a few cents. So what a change of events here just in the past three sessions. When we were down at 980, kind of make or break territory. And now we're talking about potential upside targets near the top end of the year's range. Big turnaround, technically, fundamentally. And it's a very, very important time of year for soybeans. So I expect this market to be pretty interesting going forward.
So what happened to that thought that we're swimming in soybeans after the big South American production year?
We are swimming in soybeans. There's quite a bit of soybeans, but when you look at yesterday's report, I think the reduction in acres and the overall drop in production, I think certainly changes the tone a little bit. And then you also have some headline risk lingering out there. We've gotten recent headlines regarding Chinese trade and soybeans from President Trump. Nothing of meaningful substance comes from that, but the trend in these headlines really throughout the course of the year across many different commodities has just been kind of a slow trickle of headlines, whether there's no substance to it or not. It keeps the shorts a little bit nervous, and when those headlines do cross, you see buying activity. We saw it earlier this week that was eventually sold into, but nonetheless, we got the headline. I wouldn't be surprised to see more headlines like that come out regarding soybeans and Chinese trade over the next couple of weeks. I'm not saying it's going to, lead to anything substantive, but again, it keeps the bears a little bit short, and that could potentially be a tailwind too going forward.
How many false bounces have we had in the wheat market now this year?
Too many to count. Wheat has just been a classic dead duck. Every little relief rally that you think is going to turn into something more is sold into pretty aggressively. $5, obviously that's going to be psychologically a significant support going forward for the September contract. The bulls certainly have their work cut out for them. From a risk reward perspective, I'd like to believe that there's value in this market and we can, trade back higher into the end of the year. But again, we have a lot of work to do. For the September contract, looking at trendline resistance, the 20-day moving average, and those old lows from May, we need to get out above 521, 525. If we can do that, potentially that starts to change the tone. But right now, the bears have pretty darn good control of the technical landscape. If you are looking to pick a bottom, catch a falling knife, as they say, I like using the options market. It gives you that exposure with limited risk.
Boy, if you look at a monthly or a yearly chart on wheat, I mean, it has some huge, huge spikes, but they only happen about once every 14 years. So we may have to wait a while before we see one of those colossal rallies again. I want to shift over to livestock today. What happened with the cattle market? It's like somebody threw a banana peel in there halfway through the trade.
And that continues to be the case. When you zoom out and look at things, we've had a huge move higher, and these big trading ranges are looking smaller and smaller the higher we go, which is normal. The notional value of the contract size is nearly double of what we're historically used to. I was looking at the 14-day average true range for live cattle. We're right at about $4, and then for feeder cattle, the average true range about $5.98 or rounded up to $6. And it seems like we're getting those daily ranges within the span of about 20 minutes during the session. So I think a lot of that speaks to how the funds are positioned right now. Very lopsided on one side of the market. So when they look to exit their positions, there's really nobody there on the other side to buy it. So you see this cascading event of selling pressure down below. And that continues to make me nervous going forward. Secretary Rollins is expected to speak on Friday, potentially headlines regarding screwworm and the Mexico border. That's going to be in Texas. So I think you probably have maybe a little bit of profit taking and risk adjusting into that. And then seasonally, August is a weaker time of year. So those two things coupled together, I think just has some people a little bit nervous here day to day.
Are options pretty affordable on cattle, or are they just out of reach for most people?
The options, yes, is the answer to that, I would say. The option values, they do have some sticker shock to them, but again, we're trading at levels that are nearly twice as much as what we're used to, so you're obviously going to pay a lot more for the option. We really like to look at it as a percentage basis. The volatility has subsided a little bit through this week's trade so far, but last week we reached the highest volatility levels of the year in live cattle and feeder cattle. So yeah, volatility is high. Options premiums look a little bit expensive right at the moment. But again, when you're trading in a $6 range on a daily basis for feeder cattle, you're going to expect to pay a little bit more.
So lean hogs seem like they're coiling up, and they actually kind of tested the upper and lower part of the range today, didn't they?
They did, and we write about livestock markets every single day in our commentary. We cover grains and livestock, and we've been talking about lean hogs kind of being a dead duck here between the 50 and the 20-day moving average, the 50-day being resistance and the 20-day being support. We like looking at that with a little bit more of a short bias, just from a seasonal perspective. We broke below the 20-day, and that led to some additional selling pressure, but then we closed right back in the middle of that range. So again, consolidation continues to be the trend in lean hogs. I don't really see anything that jumps out screaming buy or sell here. I'd rather probably sell it higher or buy it lower. Right here, smack dab in the middle, I think it's just kind of a wait-and-see moment.
Any words of wisdom here on the precious metals? I saw where gold at one time, December gold, I think was something like $23 or $24 higher, and then it really faded toward the end of the daytime trading session there. I don't know what's driving that especially, but a while back it tried to break out to the upside, couldn't get it done, and now it's kind of floundering sideways again.
Yeah, and here we've got the December gold contract pulled up here on the chart, and yeah, we had that big move higher, a rejection just above 3,500, which is like a quintuplet top. I don't know what you'd call it, but we keep rejecting the top end of that range, and that's brought us back to a little bit closer towards the lower end of the range, maybe the middle of the range. So I think this continues to be one of those markets that is a little bit more tradable. I have been a gold and silver bull for a very long time. I'm a little bit of a bug, hold physical gold and silver. So I'm eternally optimistic that we're going to continue to see this market work higher. But right here, kind of in the middle of this recent trading range, I think patience might pay. So I would wait for a little bit more of a pullback and use that as a buying opportunity in the gold market.
Okay. I did notice, before I let you go, I did notice that we had some weakness in the energy markets. Again, crude oil seemed to be under pressure today, and that always catches my attention, especially when you're coming into fall harvest and, things like, crude oil and diesel fuel, of course, are going to be important for farm machinery, but also I think about natural gas and its use in grain dryers this fall.
Yeah, crude oil has really been under a lot of pressure for the last 2 weeks. Today's lower close going to be the 9th lower close out of the last 10 sessions. So a lot of pressure there. Inventory report was undoubtedly bearish today. We had a big build in inventories well above expectations. So that led to continued pressure. But it really brings us to an interesting point on the chart. $62 was a big technical level going back to April. And then in May, that was big resistance. We were able to break out above there in June. So $62, that was old resistance. The breakout point from June, now going to be a very significant support. The bulls really want to see this defended into the weekend and beyond. I think there are maybe some concerns that the meeting between President Trump and Vladimir Putin could maybe go better than expected on Friday. That is debatable. We'll see. But I think that may have been weighing on prices along with that big inventory build. So energy complex going to be probably pretty interesting coming out of that meeting going into next week.
I like the look of your charts that you have there, and you said anybody can get access to those?
Yeah, clients, or if you want to try it out, you can take a demo. It's our Blue Line Edge trading platform. This is the desktop version, obviously. We've got a great mobile platform as well. And again, we've got a lot of clients that trade on a daily basis and a lot that just trade a few times a year, but they like having access to it and kind of do their own chart homework and lean on us as little or as much as they need to help them kind of navigate these commodities, whether it be the agricultural markets or the outside markets. We've got a great team here that covers a lot of different spaces.
And of course, you guys put out all kinds of reports during the day too, right?
We put out a lot of great content. I do the grain and livestock write-ups in the morning. My colleagues cover the precious metals, energies, indices, etc. You name it. We've got you covered. And then we're doing afternoon content. Obviously, you and I are speaking here today. So a lot of good information. And the portal on bluelinefutures.com updated throughout each trading day with more breaking news as things unfold.
And don't forget, we're going to put Oliver to work next week, I guess, on the annual crop tour, right?
The annual crop tour, we're going to do the eastern leg, so I'll be starting in Ohio, going through Indiana, Illinois, Iowa, and then up to Minnesota. A lot of people think that the crop tour sounds like fun, but boy, is it a lot of work. I got to do my normal job, and then, every 15 miles or so stop and go check fields. So it's going to be a big week, a busy week, but it'll be good to get out there and kind of see what's out there for ourselves.
All I can say is you better hydrate now and get started early.
Absolutely.
All right, Oliver, good to talk with you again. Thank you very much. Appreciate it. And let's do this again here on Friday. We're talking with Oliver Sloup today of Blue Line Futures, and that'll do it for Markets on the Move. I'm Marlin Bohling. Hope you have a good one.